First it was the US rate cut, now it's been Chinese stimulus. The market has got a few bits of good news that have allowed it to edge out slightly further and further gains. But now that this good news has happened, will we keep rising, or will that be it for global markets? So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 1st of October, 2024. Before I get started, you do need to be aware that what I say is general advice only, and you have to consider whether it's appropriate for you. Last week, the Chinese government announced some stimulus measures. They cut interest rates, they handed out money to the poor, they reduced lending standards. They did a whole bunch of things, and that triggered a big bounce in iron ore, other key commodities. It triggered a bounce in Chinese share markets. It triggered a bounce in the large Australian miners. A lot of what we saw was short covering. A lot of what we saw was, speculators. What I would suggest is that I'm not 100% convinced this will be a turning point for the Chinese economy. Now, they've stated this is part of their goal to achieve 5% growth for this year. They certainly won't achieve that for this year. Whether they achieve it for next year or not is up in the air. The reality is the Chinese economy's problems run deeper than the monetary policy settings. They run deeper than, a certain amount of short-term fiscal spending. They're basically a structural problem. They've grown large in a race to the bottom of, exporting manufacturing at the cheapest possible price. If they want to transition into, a more developed economy, they need to transition more towards domestic consumption of domestic services, and maybe even domestic goods. There's a huge amount of reform that'll have to go on to achieve that, because otherwise they're going to be competing with, increasingly less developed countries in the global manufacturing, race to the bottom, basically. So I think they need to do more to achieve longer-term economic growth, and the short-term sugar hits that this provide, they will look good on paper, but I'm not sure they're going to create a whole load of lasting longer-term, economic product or economic development. Whether or not this triggers a rebound for the iron ore miners, I think it will in the short term, but again, longer term, once this speculation is washed through markets, once the short covering is washed through markets, will this lead to a longer term sustained increase in iron ore demand? Not super convinced by that. Will this lead to longer term higher prices in those key commodities? I'm not super convinced by that. Will this lead to a longer term price increase in the iron ore miners? It possibly will, but I don't think it's just going to be a rebound to those prices that we saw when iron ore was 200 a ton. If anything, we'll see perhaps a reduction of the short interest and a stabilization, at slightly higher than current prices. Overall, like I said, there's a huge amount of problems with the Chinese economy, and lowering interest rates, giving some people some handout money, is not going to fix those problems. Elsewhere, we've had Jerome Powell speak overnight. Obviously, he delivered the 0.5% rate cut last month, and overnight he took a more hawkish tone. He actually suggested probably the next cut will be 0.25%. He suggested that the Federal Reserve will be data dependent moving forwards. Rate cuts aren't guaranteed. And actually, that was probably what the market wanted to hear. The market's most concerned about the potential for a US recession. And if the Fed starts saying, rate cuts probably going to be a bit slower, a bit smaller than expected, that means that the Fed sees less potential for recession. Now, I'm personally of the opinion that the market should be more worried about reinflation. There's a ridiculous amount of US government fiscal stimulus at the moment. The US government is running record deficits. They're pumping money into the economy. They're actually pumping more money into the economy now than at the depths of COVID. That's how big their deficits are right now. Why would that trigger, a recession when they're printing so much money? They're printing essentially $1 trillion every 100 days. If the US economy was to enter a recession right now, it'd be in the face of, a huge amount of inflation, being pumped into the economy. So I think that the market should be more worried about reinflation, because the reality is US consumer prices have only fallen for a couple of months. They didn't fall for most of the year. They fell for a couple of months after a bit of a dip in oil, bit of a dip in transport costs, and a bit of a dip in inflation in the Asian region. And yes, that did lead to a couple of months of prices falling. But the reality is they didn't fall for 9 months. So I would be extremely worried about the potential for reinflation. US government spending isn't going to be cut before the election. The US Federal Reserve just cut interest rates. We're about to see potential supply problems with a huge strike at many ports around the US, and with a hurricane hitting, or devastating really, a lot of the southern states of America. I think the big concern should be should be prices going back up, and the path of interest rates having to turn back around. But regardless, the US market saw his speech overnight as a sign that a recession is less likely. The next thing that the US markets will look at from a recession perspective will be Friday's jobs report. Unemployment is expected to remain pretty steady from last month, but people will be looking for clues from the report. And indeed, it was a jobs report, payrolls data, that triggered the big selling that we saw at the start of August. This reading is expected to be basically in line with last month's reading, although we probably will see it revised lower in the middle of the month, and that could lead to a slight uptick in unemployment at the middle of the month. Overall, though, US economic data has been pretty strong, and until we maybe see some of the effects of perhaps this hurricane hitting the US, or the general strike that we're seeing affecting the economy, can't really see it deteriorating too much in the short term. Could be completely wrong, however, so we'll need to keep an eye on that one. And also, we do have some company earnings reporting coming up soon as well. So let's have a quick look at the charts for this week, guys. We can have a look at our own market. It hit an all-time high yesterday, just above 82.50 there, and that was on the back of the Chinese stimulus announcements. We saw iron ore jumped over 10% on the day, and today we're sort of giving some of that back, seeing a bit of profit taking. Should we fall off from here, we should see some support right around this uptrend line here, and then there are other key levels all clustered around here at 81.50 and 8100. If we break below those levels, we could see some further selling, perhaps even all the way down to 79.20 in the short term. Overall, our market does look quite overbought in the short term and extremely overbought in the long term. It doesn't mean it's going to turn around from a longer term perspective right here, but I have been theory crafting for the last couple of months, and I have sort of considered, what would be a turning point for the global market uptrend, that's occurred for the past 12 months. And one potential could be, the US Federal Reserve interest rate cut that we saw last month. I know obviously things have gone ever so slightly higher since then, but we have had a spate of very positive news for markets as well. That interest rate cut, as it was sort of approaching, it acted like a carrot dangling in front of markets. Markets are very forward looking, and they were going, what's the next, what do we have to look forward to in the future? What's the next thing for the economy? What's the next thing for our shares? And as the rate cuts out in front of us, it means, the rate cutting cycle is out in front of us. Now that the rate cutting cycle is here though, will the market's consciousness move on, beyond the rate cutting cycle? And what occurs beyond the rate cutting cycle? Well, the market's worried that a recession might occur beyond the rate cutting cycle. I would suggest that a period of reinflation could occur beyond the rate cutting cycle. But I would suggest that, that first rate cut could act as a bit of a spiritual peak for global markets, because now investors might start looking forward beyond that point to potentially more negative things. Looking at the US S&P 500 chart now, they have gone up a little bit, ever so slightly after the rate cut. This was the day after the rate cut, this day here. But they've struggled to go beyond 57.70 in the short term. If they do go beyond that, not too sure how much further they'll go. But new peaks have been incrementally small for the S&P 500. Should they fall off from here, we've got potential support levels at 56.70 and 56.50. If those break, we could see a move back towards 5400. Alright guys, I will wrap it up here for this week. Hopefully you guys enjoyed. If you did, click like, click subscribe, and we'll see you next time.